Everyone's got an opinion on this. Your colleague who stays glued to his phone all day watching some green and red chart, he'll tell you trading is the path to fast money. Your dad who bought shares in some company decades ago and barely looked at them, he'll swear by investing. So who's right? Here's the honest answer. Both of them can be right, and both of them can lose everything if they don't know what they're actually doing. The problem isn't trading or investing. The problem is that most people jump into one of them without understanding what makes each one work, and more importantly, what makes each one dangerous. In this video, we're going to break down exactly what trading and investing are, how they differ, and by the end, you'll know which one actually makes sense for you. Let's get into it. Let's start with trading. At its core, trading is simple. Buy something at a low price, sell it at a higher price, repeat. The key word here is fast, because traders are trying to profit from short-term price movements, not from the long-term growth of a business. We're talking hours, days, sometimes weeks, but almost never years. The main tool traders use is called technical analysis. Forget looking at how a company runs its business. Traders don't care about that. What they care about is the price chart. Specifically, they study something called a candlestick chart, where each candle shows how a stock's price moved over a set period. Green candle, more buyers than sellers, price went up. Red candle, more sellers than buyers, price went down. Traders look at patterns in these charts and try to predict where the price is headed next, based on the idea that history tends to repeat itself in the market. Quick example. Imagine a stock is trading at $100. You study the chart and believe it'll drop to $90 before bouncing back up. You wait. It hits $90. You buy. It climbs to $115. You sell. That's a $25 profit on one trade. Sounds like a clean system, right? Here's where it gets real. Technical analysis is not a guarantee. It's an educated guess built on patterns, and sometimes those patterns break. You buy at $90 expecting a rise, but the stock slides to $75. Now you have a decision to make. Hold on and hope, or cut your losses. This is where most traders use something called a stop loss, a preset price point where you automatically sell to prevent a small loss from turning into a disaster. If you set a stop loss at $82, the stock sells automatically when it hits that level. You lose $8 per share, but you didn't lose $30. Smart. But even stop losses don't make trading easy. There are three main types of trading you should know. Day trading. You open and close trades within the same day. No overnight positions. This is the most intense style. You're basically glued to a screen. Swing trading. You hold positions for a few days to a few weeks, riding short-term price swings. Position trading. You hold for weeks or months, aiming to catch a bigger trend. It's the most relaxed form of trading, though it's still far more active than investing. And trading isn't limited to stocks. You can trade currencies, that's Forex, commodities like gold and crude oil, and of course, cryptocurrencies. Here's the honest reality of trading. Studies consistently show that the majority of retail traders, everyday people like you and me, lose money in the long run. A 2023 study of Brazilian futures traders found that over 97% of those who stuck with day trading for over 300 days ended up losing money. That's not a reason to never trade. It's a reason to take it seriously and never go in without proper knowledge. Now let's talk about investing. Same starting point. You're putting money into assets, but the entire mindset is different. Investing is about building wealth slowly and steadily. You're not trying to catch the next price move. You're betting that a company or an asset will be worth significantly more in 5, 10, or 20 years than it is today. Where traders use technical analysis, investors use fundamental analysis. Fundamental analysis means looking under the hood of a business. How much revenue is it generating? Are profits growing year on year? Is the company carrying too much debt? What does the leadership team look like? Investors don't care if the stock price drops 8% this week. What they care about is whether the business itself is still strong and growing. Let's make this concrete. Say you do your research and find a company, let's call it Brightbolt Electric. You believe the electric vehicle industry has massive growth ahead, and Brightbolt has strong financials, a great product, and smart management. You buy 20 shares at $500 each. Total investment, $10,000. Some years the stock dips, new cycles come and go, but Brightbolt keeps growing. New factories, expanding markets, rising profits. On top of that, they pay a dividend of $15 per share every year. So you're earning $300 annually just for holding. After 8 years, Brightbolt stock is trading at $1,800 per share. Your $10,000 is now $36,000, and you've collected $2,400 in dividends along the way. Total, $38,400. Now here's what most people get wrong about investing. They think it's passive because it's slow. It's not passive. It requires real research up front. The patience part comes after you've done the work. Buying randomly and hoping for the best isn't investing. That's just expensive optimism. Beyond individual stocks, investing covers a wide range of assets. Mutual funds, a pooled fund managed by professionals who invest across multiple stocks and bonds on your behalf. Great for beginners. ETFs, exchange-traded funds. Similar to mutual funds, but you can buy and sell them on the stock exchange like regular shares, usually lower fees. Bonds. You're essentially lending money to a government or company and they pay you back with interest. Lower risk, lower reward. Real estate. Property that generates rental income and usually appreciates over time. And yes, even crypto can be approached from an investment lens, though it carries significantly higher volatility than traditional assets. Let's put this all together cleanly. Time horizon. Trading operates in the short term, hours, days, or weeks. Investing is a long game, years, sometimes decades. Warren Buffett has held shares in Coca-Cola since 1988. That's over 36 years and counting. Analysis type. Traders live in price charts and technical patterns. Investors dig into company financials and business fundamentals. Risk level. Trading is higher risk. One wrong prediction in a leveraged trade can wipe out your capital quickly. Investing, done properly, carries risk too, but it's spread over time, which significantly reduces the impact of short-term market swings. Attention required. Traders monitor markets constantly. It often feels like a full-time job. Long-term investors can check in monthly or even quarterly. You let the business do the work. The most important real-world example? If you had invested $100,000 in Reliance Industries stock in 2010, it would be worth roughly $700,000 to $800,000 today, without doing a single trade, just buying and holding. Here's the truth. There's no universally better option. It depends entirely on you. If you want faster returns and you're okay with higher risk, you enjoy monitoring markets, and you're willing to put in serious time to learn, trading might appeal to you. But please don't start with your savings. Start with money you can afford to lose while you learn. If you want to build real wealth over time, don't want to babysit a portfolio every day, and you're willing to be patient, investing is likely the better fit. Start early. Stay consistent. Let compounding do the heavy lifting. And here's a thought. You don't have to choose just one. Some people invest the bulk of their money for the long term and allocate a small portion to learn trading on the side. There's nothing wrong with that approach, as long as you keep the boundaries clear. Whether you trade or invest, the single most important thing you can do before putting any money into the market is educate yourself. The market is full of people who are very good at taking money from people who didn't bother to learn the rules. Knowledge is the only edge that doesn't expire. If this video helped you understand the difference between trading and investing, hit that subscribe button. Because on Scribble Finance, we're going to keep breaking down complicated money topics in a way that actually makes sense. See you in the next one.